Let's talk about two topics now that are very, very important in the spotlight. That is negative gearing and capital gains tax. So we'll start with negative gearing. And what we're going to look at is what is negative gearing, what are the proposed changes to negative gearing, and what are some of the ways it might affect Aussies. All right, so let's have a quick look at negative gearing, what it is, so that you understand it from a high level. So an investor has an $80,000 income. So a person has an $80,000 income. Their rental property brings in 20 grand a year. Okay, that's the income that they receive. But after they paid rental management, interest, maintenance, strata, etc., the property actually ends up costing $25,000. So that holding cost creates a $5,000 net loss for that landlord. So they're actually losing 5 grand every single year in holding costs. We're not talking about capital growth, it's the holding cost of the asset. They're running at a loss, okay? That loss then actually gets deducted from that individual's personal income, their taxable income. So instead of them being taxed by the ATO at $80,000 a year, because they've had a $5,000 loss, they're not going to pay tax on money they didn't make. So they're actually going to get a $5,000 discount on their taxable income. So in the eyes of the ATO, this person is not making 80,000, they're actually only now making 75,000. And because they're getting taxed at a lower amount, this constitutes as a saving, okay, as a benefit to them. That's negative gearing. Now, the rumoured changes for negative gearing, what are they and what do they kind of look like going forward? All right, the rumour is, remember this is all speculative, but we will know in a couple of weeks' time in May. The rumour is that they're going to limit negative gearing to a maximum of 2 properties, 2 investment properties. Any property beyond number 2 that you own as an investment, negative gearing tax benefits will not be there. So the holding cost of those assets is all on you now to cash flow that yourself. I want to show you a quick historical fact that I think is very telling of what might come after this. I want to take you back in time, and these articles are from the 14th of March 1987 and also from 1985. And what happened is in 1985, the Hawke government at the time abolished negative gearing. They took it off the table. You couldn't use it anymore. Okay? In 1985, they took it away because people were worried that these greedy landlords were just taking advantage of tax, and this is why they were buying up all the properties and all the usual things people whinge about. Now, I'm not very sympathetic because of these reasons, and I'll go into them in a moment. Now, what ended up happening? What ended up happening was they took the benefits away from landlords, and those landlords stopped buying investment properties. When those landlords stopped buying investment properties, there was less property that was available for renters to live in. So what happened? The knock-on effect was instead of 20 people showing up to a for-lease open inspection property, you had 60 people show up to a for-lease open inspection property because there was less property available, less competition. And if there's less competition, what do you reckon happened to rents? They increased by about 30% in 2 years. So the same people that were shouting for the heads of landlords who were just so greedy and take so much advantage of the working class man, those same people went back to the bank on their knee, back to the government on their knees and said, please give them back their benefits so they start buying properties. Another interesting side note here is that the Australian government did not step in any way and say, don't worry, we're going to house all of you and we're going to build affordable housing, just like the Albanese government said that they were going to do, and just like the data is showing they can't reach that target. So what they did is, at the time, Paul Keating, who was soon to become Prime Minister, was actually the Treasurer. And Paul Keating turned around and said, we're actually going to flip this. So we're going to reverse the policy. It's not going to happen anymore. We're going to give negative gearing benefits back to Australian landlords. My prediction is if they do that again, because in 1985, 86 and 87, they didn't have the vacancy rate issues that we have today. They didn't have the skilled labour shortage issues that we have today. They didn't have the immigration policy that we have today. They didn't have the development application deficit that we have today. And they certainly did not have the same costs of build materials going through the roof since COVID that we had today. So if it took 2 years for them to reverse that policy last time, how long do you think it's going to take until people are on the streets screaming for blood to get the government to reverse its policy again? That's why I'm not stressed. If this gets passed, I'm not worried at all. Now, let's look at the effects of negative gearing. Based on recent ATO data, around 49% of the 2.26 million property investors in Australia negatively gear. 2.26 million investors out of about 27 plus million people in our country is actually not a lot, okay? So they're saying half of those people, or just less, 49% of those investors actually negatively gear. Why is that really important? Well, nearly 60% of those investors have taxable incomes of under $80,000. These are not rich people who are doing these investment strategies. These are just proactive, hardworking Australians that are saying, I am not putting my faith in the government to take care of me or my family at retirement. I'm going to do something about it for myself. And that's why I get so passionate about this and upset when I hear people talk bad about landlords, or they talk bad about the government giving too many benefits to them. It really isn't working like that. These are people that are trying to make an honest living and trying to make life easier for you. Yes, there's going to be a bad apple every now and then, but I'm just saying the data shows the majority of them are just hardworking Aussies. Now, I actually broke down this data to see if today they didn't grandfather it, if they just said, as of today, everyone that owns three or more properties, your negative gearing benefits are confiscated from you as of today. Okay? They're not going to do that. They'll grandfather it. I'm quite confident. But let's say they did it today. Almost 70% of Australians own a home. And according to the ATO, 30% of that 70% don't have a mortgage. Okay? They're paid off. My parents, your parents, my grandparents, etc. don't worry about interest rates. They're worried about petrol at the pump. They're worried about buying avocados and broccoli and how expensive that is. That's what's affecting them, not interest rates on their home. Approximately 2.245 million Australians owned at least one investment property. So according to the ATO, 71.48% of investors hold one property. That's a huge chunk of that percentage, just holding one. Look how much it drops. 18.86% of investors hold two properties. These people will not be affected by the limiting negative gearing changes, okay? Because they only own two properties. It's only if they owned a third property. Let's see how many people in Australia own three investment properties or more. 5.81% own three. 2.11% own four. 0.87% own five. And 0.89% own six or more. Let's do some crazy numbers here because it seems like the people in the government won't do it. Let's assume that entire number of that percentage of people that own 3, 4, 5, 6 or more was put together. They represent about 217,000 investors. Okay? In the grand scheme of things, that's not a lot of people. Less than 250,000 Australians own 3 or more properties. Not a lot of people at all. Let's assume all of those people, even though it says only 49%, let's assume all of those people take advantage of negative gearing. Absolutely, they wouldn't be. You'd get people that would have inherited properties. That's how they make their money. They don't have any debt on them. But let's just assume 100% of them take advantage of negative gearing. If you were to take those people off the board, it's only 217,000 people. How would that affect policy, or how would that affect the property market for the better for those people looking for more affordable housing? The answer is it won't. Let's keep going. The effects of negative gearing changes. How is that going to affect things? Here are what I think is going to happen and what most, I think, professionals also agree. First, we're going to get the storm before the storm. What am I saying here? If I tell you, as a member of our illustrious government, that we're making changes to negative gearing or capital gains tax, most likely what I'm going to do is not hit you with it and say, from today, this is what's going to happen. I'm going to say, from this date in the future, if you buy a property after this specific date, you will not receive these benefits going forward. It's called grandfathering, and they've done it in the past, okay? What do you think will happen if I tell you you've got 12 months to buy as many properties as you possibly can get your hands on before these new very crippling policies come in to affect investment. You are going to get ready, get set, and run as fast as you can to the bank and then to the marketplace to buy as many properties as you can, so that once this policy comes into place, your properties are immune. That's what you're going to do. That is going to be the biggest rush to buying properties that we've probably seen in the last half century, since they changed capital gains tax back in 1985. That's what's going to happen. What's going to happen to lending? Well, after the policy's been done, and you can no longer take advantage of negative gearing for multiple properties, more than two, banks are going to look at that and say, well, you can't service this as much because you're not getting those tax benefits. So your borrowing capacity will most likely drop. That's another thing. Property supply. Grandfathered investors will hold on to their properties for much longer rather than actually selling or reducing their transactions. So the amount of stock on the market is going to shrink even more than what it is today. Okay, and we're already in an area where we just don't have enough stock. Next, rents. Rents are expected to increase by 15 to 20 odd % in that 12 to 18 months afterwards, because there's going to be less people buying rental properties, which means less properties for people to rent in. That's what's most likely going to happen when it comes to the changes of negative gearing. Now let's have a look at capital gains tax. Now, capital gains tax is when you buy a property and the property makes $100,000 and you sell that property, after all of your costs, whatever the profit is that you've made, currently at the moment, the ATO taxes you 50% of that profit. So if you made $100,000, you pay tax on $50,000, and the other $50,000 profit you don't pay any tax on whatsoever. That's what CGT is. What are the rumoured changes? The rumoured changes is that they're thinking about dropping the CGT discount from 50% to 33% discount. Okay? So for someone on a top marginal tax rate of, let's say, 47%, it's actually closer to 52% after you put the Medicare levy and insurances on top, but let's say 47%, this represents about a 33% increase in the CGT that they'll end up paying on a property. It's quite significant. Now, what are the effects of capital gains tax going to be? Again, you'll get the storm before the storm, but the biggest issue is you're going to get people holding on for dear life. That's a crypto expression, good old hodl. So to make up for the additional hit to their profit, because they can't make as much profit because the increase to the decrease of the discount for capital gains tax, owners will most likely hold onto their property for longer than the average, and that's to make up that difference. This is going to result in less sales and less available stock. Less sales also means less transactions. Less transactions actually means less stamp duty, capital gains tax, and less stamp duty from people buying, which actually results in less tax and less money for our Australian government. Any way you slice it, this really does not make sense. And I'm very curious to see what happens in May when this budget is finally announced. But I think this is going to be the lead up to one of the greatest runs of people trying to buy as much property as they can get their little sticky fingers on before these policies come into place. And I don't have faith that policies like changes to negative gearing will even be long-term and stay. Before I go, I just wanted to say thank you. We are the Australian Small Business Champion Award finalists for 2026. It's always an honour to get votes for our clients and to see that back. We're very passionate about property here at Providence and helping people just make a better future for themselves and their family. We're very specific about what we don't buy, what we don't do, the type of product that we stay away from, the locations we stay away from. By sticking to those rules, we've been able to do this for over 20 years now and make people a lot of money. So thank you. It really means so much to us. Remember, we can't help you until you commit. And once you commit, we won't let you fail. We are bringing two things here. We're bringing your desire to build wealth and our 20 years of buying experience together here. And that's a winning combination. For more than 3 decades now, we've been helping people purchase property all over the country, helping Australians open a life of opportunities through real estate, giving them the future that they actually want. And we buy unique quality assets that appeal to much larger audiences of owner occupiers, not just investors. We buy in the right capital cities at the right time, guided by the economic property cycle. And we buy the property which is uniquely suited to your situation, which will act as a springboard to your next wealth building stage. This is how top performers buy property. This is how they invest. Thank you so much for your time, and I'll see you again next month.